We just finished going through AEHR Test Systems fiscal 2026 fourth quarter earnings materials, and now we want to walk you through what we found. Here's the number that stops you cold. Revenue for the full year fell 15% down. And yet I'm telling you, this might be the most bullish down year I've read in a long while. Sit with me for a second, because the story isn't in the review, it's in that last quarter. Let me show you why a shrinking year can mean the engine just turned over. So here's the shape of it, and I want you to picture a chart that dips, bottoms out, then rips. The company reported full year revenue around $50 million, down 15%. That's the rear view. But look what happened in the fourth quarter. Revenue came in at $18.8 million, up 34% year over year. That's the breakout. And this is the one that matters. The filing shows non-GAAP earnings flipped from -1 cent to positive 11 cents, from losing money to making it. Gross margin hit 45%. Then management put a number on the windshield. Fiscal 2027 guidance of $130 to $150 million, up 106% to 200%. Now, to be fair, that guidance is unrealized. It's a promise, not a receipt. But our take is this: when a company troughs and inflects in the very same breath, you pay attention. Let me teach you the actual business, because if you don't get this, none of the numbers land. The report lays out two systems. The first is Wafer-Level, they call it folks, and it stresses the chips while they're still on the wafer before anyone cuts them apart. The second is Package-Level, called Sonoma, and it stresses the components after they've been individually packaged, aimed at high power stuff. Same goal for both. The company says find the chips that are going to die early and kill them before they get built into something expensive. Here's why that matters now, and this is my read, not theirs. When you're stacking a dozen dies into one AI accelerator, one bad chip poisons the whole package. So wafer-level screening stops being a niche and starts being table stakes. The market still files them under niche technology leader. We suspect that label is about to get stale. Now here's the part that makes an old value guy smile. You sell the machine once, that's the AIstocks and Sonoma hardware capital equipment. But every new chip design your customer builds needs a fresh WaferPak contactor, and that's a consumable. They buy it again and again. The company reported WaferPak revenue of $5.8 million in the quarter. And get this, that's 31% of Q4 revenue. Almost a third of the quarter, recurring. Think about the razor and the blades. They land the razor once and the blades keep coming. And the pitch to the customer is almost unfair. The filing puts the total test cost at roughly 0.1%. Do the math yourself. You spend a rounding error to screen the chip. Because if one bad die slips through and gets packaged, the company says the whole multi-die system and its memory gets scrapped. Pay a dime, save the dollar. That's a value proposition that sells itself. Alright, back to that down year, because I promised you it was good news and I owe you the why. In the rearview, fiscal 2026 revenue fell 15%, and the company is clear about the cause. They were phasing out the legacy electric vehicle silicon carbide business, a transitional trough. Fine. Now look through the windshield. Q4 revenue up 34%, earnings of 11 cents, and the one that really talks, gross margin at 45%, up a full 1,000 basis points year over year. Management pins that jump on product mix and better utilization. Here's the tell, and I want you to sit with it. They hit 45% margins at the bottom of the revenue cycle, at the trough. When your worst revenue quarter is also your fattest margin quarter, that's not luck. The new business coming in is just structurally more profitable than the old business going out. To be fair, one quarter isn't a trend, but I'm maybe 70% that this margin sticks. This is the slide that reframes the whole company, and the deck calls it a blood transfusion, which is honestly the right word. Rewind 2 years, and this was basically an electric vehicle silicon carbide shop, nearly all of it. Now look at fiscal 2026. Electric vehicle carbide is under 5%. AI and data center is 71%, and data center silicon photonics is another 20%. The report says more than 80% of Q4 revenue now comes from AI processors and photonics, and that was just 56% a year ago. That is a company swapping out its entire bloodstream in about 24 months. Their conclusion, and I don't disagree, is that they're taking the same core contactor and burning capacity they built for cars and pointing it at AI, where demand is hotter and margins are richer. The bears will say sure, but that's just chasing the crowd into AI. Fair point. My take, they're not chasing, they already got there. If the pivot is the engine, this next number is the fuel in the tank. The company reported Q4 orders of $60.7 million, up 500% year over year across Sonoma, Fox, and WaferPak. Now I have to flag something, and the slide flags it too. $41 million of that is a single Sonoma mega order from one hyperscale data center customer booked in April. Hold that thought. We'll come back to the concentration. Roll it up and end of year realized backlog was $80.6 million. Then another 20 million of orders came in after the fiscal year closed. Add it and the effective backlog sits at $100.6 million, a record. That's the number underpinning the $130 to $150 million guidance for fiscal 2027. So the guidance isn't pulled from thin air. A big chunk is already booked. But be honest with yourself, one $41 million order is doing a lot of the heavy lifting here. Here's the first of 3 growth engines, and it's the strongest one. The company says its primary AI client moved 100% of production burn in over to AEHR's Wafer-Level approach and dropped system-level screening entirely. That's not a trial, that's a customer betting the whole line on you. They're ordering fully automated aligners and doubling their system count this year. Then the Catalyst, a top-tier AI or CPU maker, ran a benchmark, and the report says AEHR's Wafer-Level performance actually beat the package-level method. So they're taking it to Taiwan foundries for pilot validation and eyeing a second component. Now here's the part that made me lean forward. The company explicitly says any revenue from this new benchmark client is not in the $150 million guidance, it's excluded. So if that client converts, it's upside on top of a number that's already up 200%. I'm not going to pretend that's a sure thing, benchmarks aren't orders. But it is a real call option. The second engine is photonics and high power packaging, and what I like here is it doesn't lean on the same customer. The filing points to a new networking giant, First Contact back in November 2023, and they've already ordered 2 9-wafer cells and 2 FOX modules. From first handshake to order in a compressed cycle, that's a customer in a hurry. On the high power side, a hyperscale client is adding record Sonoma capacity, and their next component draws twice the power, ramping this year. The company says its next-gen Sonoma is being built to handle 2000 watts per component for the next wave of GPUs and CPUs. Here's why the whole slide matters, and it's their point and I agree with it. This photonics and high-power leg gives them a second source of volume that doesn't depend on the primary AI processor story going right. 2 legs to stand on beats 1. That lowers my worry, at least some. The third engine is smaller, and I appreciate that the deck is honest about that. On silicon carbide, the very business they were phasing out, the company reported $8 million of new wafer-level and WaferPak orders right before earnings. That includes a direct order from a top global automaker, and they landed their first Taiwanese carbide client, taking that seat from a Chinese competitor. So the legacy business isn't dead, it's stabilizing. On gallium nitride, they say they completed the world's first 300mm GaN wafer-level burn-in solution, validated across more than 12 component designs. Sounds exciting, right? Here's where I give management credit for not overselling. They flat out say the total gallium nitride market is about 1/10 the size of AI or memory. Their own words, this is upside optionality, not a foundational pillar. That's the kind of straight talk I trust, so treat this engine as a bonus, not the thesis. Let's audit whether they can actually build all this, because a great order book means nothing if you can't ship. The company says it runs 2 parallel lines, contract manufacturing in Southeast Asia doing 20 plus Sonoma systems a month, and the Fremont headquarters doing 20 plus wafer and package systems a month. Their RID, and it holds up, is that $150 million of revenue won't be bottlenecked by the factory. Now the balance sheet, and this is the part that de-risks it. Cash sits at $116.5 million, up from just $26.5 million. And yes, they got there by selling stock through a $100 million at the market offering, so existing holders got diluted to own that. But here's the kicker, full year capex was a mere $2.1 million. Read that again. They can scale to $150 million without building expensive factories. That's an asset-light model, and it means growth depends on demand showing up, not on pouring concrete. Now let me play referee, because a good deck tells you what management wants you to hear, and a good analyst tells you what it actually means. Claim 1, the transition is complete and Q4 proves profitability. Our translation, credible and realized, that margin jump at the revenue trough confirms the unit economics genuinely got better. I'll give them that one, it happened, it's right there in the numbers. Claim 2, 160 to 200% growth driven by the record backlog. Here's where I pump the brakes, that's a forecast, not a fact. The whole trajectory is tethered to a handful of big clients executing on schedule and schedule sleep. Claim 3, guidance is robust, but leaves out memory and the new benchmark client. I'll read, that's structurally conservative, and it's the good kind of caveat. It means real upside if those secondary catalysts fire. So 2 greens and a yellow on the honesty check, a fair scorecard for a company mid-inflection. I love this slide because how management answers is often louder than what they answer. On capacity, analysts pushed hard on manufacturing limits, and the report says management came back with specific unit and dollar frameworks, assertive, transparent green light. On product mix, they pushed for a breakdown and got clean numbers, roughly 7% AI, 15 to 20% photonics, about 30% consumables, all out in the open, green light. Then came memory and the vibe changed. The company says management showed obvious hesitation and actually told investors not to put too much memory in your models until firm commitments arrive. That's a red light, and the tone was evasive. Now, is that a bad sign? Here's the mature read. It cuts both ways. Either they're hiding a weak spot, or they're sandbagging a real opportunity so they can beat it later. The deck's bottom line, generous on operations, deliberately holding memory down. I lean towards sandbagging, but I'm honestly not sure yet. Alright, I'd be a lousy referee if I only sold you the upside, so let's talk about what can break. First, concentration, and this is the big one. The filing says 3 clients each drove more than 10% of Q4 revenue. Remember that $41 million order. If any one of those whales delays a deployment, the quarter looks ugly fast. Second, the margin suppliers, including NVIDIA's power supply vendors, are raising prices up to 40%, and that's a direct shot at the shiny new 45% margin they just posted. Third, the memory gap. Memory is a giant market, and it's completely outside the guidance. The biggest dream here is also the least certain reality. And fourth, the company itself admits the business is lumpy, CapEx cycles are non-linear, revenue jumps around quarter to quarter. None of these are deal breakers on their own. But stack them up, and you understand why this stock swings so hard. Eyes open on all 4. Here's the whole debate on one page, and it hangs on a single idea. As AI stacks more dies into one package wafer, level burn-in stops being a luxury and becomes a yield necessity. You have to screen before you build. If that's true, AEHR is sitting in exactly the right chair. The bull path is simple. The primary AI client hits its timeline. The benchmark client converts to real orders, Photonics and Sonoma scale, and fiscal 2027 clears $150 million while the lumpiness smooths out. The bear path is the mirror image. The mega client delays. Memory never shows up. The carbide recovery stalls, and the growth story cracks. And here's the sting. At this valuation, the multiple compresses immediately. Our stance, and I'll say it plainly, the Q4 turnaround that already happened is highly credible. That part is real. The giant fiscal 2027 breakout is technologically sound, but it demands you watch execution every single quarter. Believe the past, verify the future. Last real slide, and it's the most useful because the company hands you the exact dashboard to grade them by. 7 gauges. 1. Revenue trajectory. Are the quarters pacing toward that 160 to 200% target? Watch the Q2 peak. 2. AI conversion. Does the new benchmark client turn into formal orders? 3. Backlog velocity. Does the effective backlog hold above that $100 million watermark? 4. Margin defense. Do they hold 45% against those supplier price hikes? 5. The recurring base. Does WaferPak stay around 30% of the mix? 6. The memory call option. Any formal agreement at all in memory? That's your free upside. And 7. The growth flip. Hard proof that the full year swings from decline to triple-digit growth. Print this list, tape it to your monitor, and check it every quarter. If those 7 gauges stay green, the story is intact, but if 3 of them roll over, you'll know before the crowd does. Alright, last thing, radar always leaves you a light. I'm weighing everything: the real Q4 turnaround, the record backlog, the asset light balance sheet against the concentration risk, the supplier margin bite, and a fiscal 2027 number that's still mostly a promise. I'm calling this one yellow. The business turned the corner. That part is flat out impressive, and I mean it. But 3 clients carry the quarter, and the stock is already priced for the breakout to go right, so I'm watching, not chasing. Here's what flips me to green, and I'm telling you this up front. If that benchmark AI client converts to real orders and they hold the 45% margin through next quarter, I go green, and I'll admit the caution cost me a little. And what turns me red? If the mega client slips and margins crack under supplier pricing, I step aside without blinking. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar. Hit the bell, like, and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.